A warm welcome to the On the Tape podcast. I'm Guy Adami. I'm typically joined by Danny Moses, who is here today. Danny, how are you?
I'm good. I was just looking around to see who else was in here.
No, you're here.
All right.
But I say typically because we're typically also joined by Dan Nathan.
Right. Chi-Town.
Huh?
He's in Chi-Town.
He is in Chicago. I don't know if we're doxing him or something.
No.
But he's in Chicago with obviously our friends at CME
Our sponsor.
Group.
Right.
Our
exactly.
sponsor. He's going to see Pearl Jam at Wrigley Field this weekend, I believe, on Saturday evening.
And maybe even this evening, I would imagine.
Well, this evening being Thursday.
Yes.
So today, as we're doing this, it's Thursday afternoon.
And I will be joining him on Saturday.
By the time you hear this, he will have seen Pearl Jam at the Affirm.
And I hope I get the better set list with him on Saturday than they do
I hope
tonight.
you do, because you're deserving of that.
Thank you so much.
By the way, you should stick around because you, Danny Moses, had a wonderful conversation with Porter Collins and one Vincent Daniel. Is that true?
We had a great conversation, about 40 minutes it went. So we're going to keep this part kind of brief because we went into a lot of stuff there, yes.
Now, I was privy to some of that conversation, and I know you like to mention artists. I know Vinny tried to invoke some artists like Diana Ross, for example.
Al Jarreau.
For example.
Yes.
By the way, nobody likes Al Jarreau.
That's not true. That's just not. I like Al Jarreau. How about that?
Well, that's good. You're one of maybe 5 or 6 people, including his immediate family. But what I'll do here is going to invoke somebody that is near and dear to my heart. I think one of the top 5 guitarists of all time, in my opinion. And that would be the great late Stevie Ray Vaughan, who passed away this week in 1990. You may recall.
Yeah, the helicopter crash.
Tragic.
With Clapton on the same tour as Clapton.
That's true.
Yes.
With Robert Cray.
Yeah,
and
crazy.
the initial news that came out suggested that Clapton might have been on that helicopter as well. Fortunately, he was not. Obviously, not great for the fans of Stevie Ray, who loved Stevie Ray. I saw him New Year's Eve, I believe, 1989 at what was the old Studio 54, but I digress. In 1989, Danny, they released their 4th studio album. It was called In Step. And one of the songs on that album is The House is Rockin'. And when I look at this market, all I can say is the market is absolutely rocking. Don't bother knocking. Don't bother punching holes in this thing because the house is rocking, so don't bother even looking at something else, Danny Moses.
Yeah, if you had told me that NVIDIA would be down, I don't know, it's not down a lot, call it 3 to 4%, and 1 point down 7, I think off of the print last night, you would say, well, that would mean the S&P is going to be down 50 handles. It's got to be down almost 1% or a little more, something in that range. And it didn't happen. So you could argue that that's actually a pretty healthy rotation that we're having here with, as we see here, Google, Alphabet's down on day. Obviously, some of the big guys are down or flat on day. And the markets come in during the course of the day. But I always say this, and it's much harder to recognize, I just think, when you're in this full state of euphoria and it feels like nothing can stop it, that's when you start to take a look to take some off the table. And the flip side, when things feel horrible and it feels like there's no way the market's ever going up, that's when you should be buying, covering. So I think, and I heard you earlier today on Market Call, if you can figure out that behavioral finance aspect when everyone's on the same side. So listen, the market is expensive. It can remain expensive on a multiple basis for a while. It's not a reason to, quote, sell it necessarily because we've seen the S&P and the markets in general are the sexiest game in town globally. So that's where the money's been coming here. But Guy, we know we have at least 25 basis points coming in September.
Yes, we do.
We have a holiday week this week. The lightest volume day of the year, I think, was 2 days ago. So we're not going to get a lot of action, I think, one way or another. We'll gear back up after Labor Day and face the issues that I think are going to be coming, and we'll deal with it then.
Okay, so you know what I think about the economy. I know what you think about the economy. We both think there are major obstacles, major potential pitfalls that I've thought would happen already that have not, but I think it's just inevitable. However, Thursday today, what we saw, at least in this snapshot, was a potential for at least what and I can't even believe I'm about to say this, but what a soft landing could potentially look like.
Or no landing.
Or whatever you want to say, but I guess not a crash landing. Thoughts on that?
James Aiken, who's a close friend, Aiken Advisors, has been writing a letter for years, incredible strategist, very thoughtful, said something today in his note that got me thinking. And, we talk about the deficit and debt, which no one cares about. However, it is an immediate cause and effect. If you're running a 6% deficit, you will have nominal GDP growth. You may not care where it comes from, how it gets there, whatever, who's funding this thing continuously. So I think that's kind of the bridge, Guy, is that appreciate the liquidity that remains in the market here, right? It's not going to get pulled anytime soon. Glimpses of some type of liquidity coming out of the market have been met with cries for 75 bips of rate cuts. If QT needs to stop, we need to go back to QE. This is going to be a long process kind of an unwind, Guy. And I think we have to accept the fact that when we do hit these critical junctures, and maybe we'll hit the juncture at some point where the unemployment rate starts to grow to a point where you can no longer ignore it, or Fed cuts won't do anything. But until we get there, I think I'm not saying as a bear, but as a market participant, you have to respect it whether we like it or not. The generational dependency on the government to both keep spending and to fix any problems from a liquidity perspective that might be out there. And that's just, we've been doing this since 2008, guys.
Well, if they're able to gloss over any potential problem historically that we've seen or have yet to see, then we really have nothing to worry about ever, right? In basically in perpetuity, we'll have a little, pitfalls here and there, but there's not going to be anything catastrophic. And, that way of thinking doesn't line up with history in terms of what has happened. So unless you think history has changed and forever we will be fine because central bankers have figured it out, I am not in that camp.
Listen, I'm with you. I just think we have to start getting away from market levels per se,
Fair.
even though we know that those will come in line in time. Think about the amount of stocks that are down 50, 60, 70% from their highs. There's a lot of them, Guy. I mean, we put Dollar General is a perfect example of a name today. I know we're going to talk about here. That's not it's no longer as big of a market cap as it was. But something like that, if that's in your portfolio and you've owned this stock for a while, you're not paying attention, guess what? You don't care about the S&P. You care that you were long Dollar General. And I'm not saying I said to short Dollar General. I'm just making an example.
Okay, so let's just talk about that for a second. So Dollar General into the fall of 2022 was everybody's darling because it made sense if you think about where we were, where people were shopping. It all sort of made sense. Lower left, upper right. Something changed effectively right around the beginning of 2023 into today. I will say this, and I never use this word, but today, Dollar Gen is crashing. This is stock that is down almost 30% today. By the way, trading $88. This is a stock that, as I mentioned earlier, in terms of in November of 2022, this was a $260 or so stock.
And what's the market cap now?
The
is
market
approaching
cap
20 billion,
now,
right?
I believe, is around $19 or so billion. Don't at me if I'm wrong. You don't see things like this at the beginning of a cycle. You see things like this typically towards the end. And ask yourself a question quickly. And you've talked about this and have been correct now for a lot longer than people give you credit for. You were pointing out how this is Walmart's world a year and a half or 2 years ago when it didn't really seem to make a lot of sense. But what we've seen over that period of time is Walmart, the pull down that they have, their average customer now averages over $100,000 in income. Now, you could say that's a function of a lot of things, but 5 years ago, adjusted for inflation, you didn't see anything close to that. So what's happening? People are coming down to Walmart, which makes sense, but now people are trading down from the dollar stores. Typically, historically, when there's a slowdown, people trade down to the dollar stores. Now we're seeing them trade down from there. From where, I don't know, but that's not a good sign. So when you see a stock like this, a company like this, have a move like this on the back of what's been a very difficult couple of years, to me, that is telling a huge story in terms of the state of the U.S. consumer.
I think that the companies that get it, the companies like Walmart and Amazon with an e-commerce strategy as well as a product strategy that makes it affordable for people and convenient to get them, which got the benefit at the time of COVID happening. So it basically accelerated this. Look at Walgreens Boots. I mean, what a disaster, right?
Mm-hmm.
And I tried to trade that from the long side about 6 or 9 months ago in the first kind of announcement. When Eli Lilly comes out and says we're going direct to the consumer and you don't need to go into a Walgreens pharmacy anymore. I mean, my point is that the company and the markets are evolving in a way, and you really have to be paying attention. And this is why I don't believe just owning the markets or shorting the markets in general is the way to go. I think shorting or selling stocks that are no longer keeping up with these changes that are going on. And Walmart has been, I think it all started really because of groceries. And they sell produce. They sell groceries, and they had the cheapest groceries that were out there. They also have Sam's Club, obviously, as you well know, and it drew people in, and they never left. I think the whole idea of a stigma of, quote, shopping at Walmart went away. And so these things that are in motion, it's very hard to, quote, turn around a company, right? It is, especially when they're big companies like a Dollar General with tens of thousands of stores. Right? You can't do it. And so that's where I'm most interested in, is finding those opportunities and trying to avoid some of these landmines that are out there to this ever-changing landscape.
And you've done a great job. I'll say this. Walmart, if you look over the last year or so, let's just play it out since January effectively. This was a $52 stock-ish at the beginning of this year. It's now trading $76. You can do the math. That's approximately a 50% move. Walmart doesn't move that way historically. Walmart, if it moves a couple percent a year, was a big deal back in the day. It was sort of slow and steady wins the race for years. Now it's trading like a technology stock, which is a great thing for Walmart shareholders, but it should at least catch your eye a little bit and say, wait a second, what does this mean? What does it portend? And again, I don't think it's particularly great. Let's talk about one other thing that happened this week. Berkshire Hathaway made the $1 trillion market cap club. Good for them. Why do I bring that up? Because something you'll hear from us and something we're hearing from the market, for the first time, I believe, ever, the Buffett Indicator, and that's total U.S. market value divided by GDP. So total U.S. market value right now is about $57.5 trillion or thereabouts. Our GDP in this country is a little bit north of $28 trillion, which makes this number just north of 200%. That is flashing red in ways that it has never flashed before. And I think one of the reasons that Warren Buffett or Berkshire Hathaway now has, I think, $280 billion of cash equivalents on the balance sheet is because of exactly that. And the reason they're paring down their position in Bank of America, and the reason they've been selling out of Apple, although that's probably a positioning thing, I think they're positioning themselves for the inevitable rainy day that we have been talking about now forever.
Yeah, listen, these indicators, these go way back too, and they're not perfect, and they can
They are not
they can go on 6
mechanisms.
months, 9 months, whatever. But it is, you're right. It's an opportunity to take a step back and say, am I really looking at this the right way? Because over a longer period of time, the market is efficient. And I'm not saying the market's not efficient right now, but to think that either GDP will catch up to the correct ratio, I don't think is realistic. Although, again, we had a revision up in second quarter.
Yes, we did.
GDP today. And, we're in this kind of soft landing, no landing scenario. But no one cares right now, Guy. But you're 100% right. When it matters, it matters. Again, I go back to the debt deficit. If that doesn't matter right now, then all those things are off the table because it's one of the drivers of it for sure, guys.
Well, one of the other things that has mattered, and I think is going to matter again, and this is something that both you and I talked about and Dan has opined, what's going on in Japan. Obviously, that Monday, August 5th, I think it was sort of set in motion by what we heard from the Bank of Japan, the subsequent move in dollar-yen, and that created this cascade effect. It seemingly stopped very quickly, and the U.S. dollar got back on somewhat firm footing vis-a-vis the yen. Recently, we're starting to see a strengthening of the yen again. And I'll say this here, and if I'm wrong in a couple weeks, I'll be the first to say it. But I think round 2 of this unwind is coming to a theater near you. And I think the market thinks it's over. It was a one-time event. I think we're getting ready for the next round of what I think will be a many-round fight.
I agree. There's no way that you just got rid of been a major driver of leverage in the system for decades, and it's over in a period of 2 or 3 weeks, and that, quote, these bets have come off and so forth. I think we're in this kind of intermezzo, so to speak, Guy, of this, right?
Intermezzo,
that
exactly. Beautiful.
So the yen's, strengthened back to kind of 144.5, 145 area. It really hasn't weakened back kind of above 148, if you want to call it that. As a matter of fact, the deputy governor had a meeting this week where they say they're going to raise again if they, quote, have to. But again, if a turmoil comes, it's people's belief from a Pavlovian response, investor response, that don't worry, Fed will have your back. They'll come and do something like that. And that's, Guy, when you start talking about the Buffett Indicator and all these historical things, that's when that stuff matters. Because at some point, there's just not any buyers left. And as we sit here today, the S&P is off 60 handles, I think, from the highs this morning, and it did not breach that 56.69 level that it hit in July. It came close a few times, did not touch it. And my point is, it failing to make new highs, obviously, from a technical perspective, you don't even need a Carter Worth to tell you that that's not good.
No, I agree with that. And again, we're seeing, we went a long time without seeing a 2% move. Now we're seeing, Again, we haven't seen 2%, but we're seeing intraday moves for the first time in a while that we haven't seen in quite some time. And again, the VIX here, a little bit north of 16. I'll say this again. If I believe that the yen is going to be a story again, almost by definition, I have to think the VIX will be a story again. And I do believe that'll take place as we get into September. So stay tuned for that. Some of the other things that we've seen, though, Danny, gold's hanging in there regardless of dollar moves. Dollar goes up, gold goes up, dollar goes down, gold goes up, yen moves, doesn't move, interest rates move, doesn't matter. Bitcoin all over the place. What's been slow and steady, lower left, upper right now for a very long time has been gold. And for the first time in quite some time, you're seeing the commensurate move in these mining stocks, which I still think are too cheap here.
I agree. And Porter, Vinny, and I talked about gold on the back half of this episode, so take a listen to that. But for sure, I think it's finally found its place. And if you know that you're in a rate-cutting cycle, whether it's 25 or 50 in September, whether it's 4 cuts by the end of the year, whether it's 6 cuts by next spring or not, you got to figure gold's going to be a factor. And just imagine this. If you changed the mindset and you flipped it instead of being completely optimistic on the markets, all the things that you believe are a driver, Fed have. What if you flipped it to the other side, the headwinds that you're going to need to face? Gold, to me, is the currency. And again, listen to what Porter has to say about it, kind of evolved in the 1970s, your time period.
Yes,
guy, and
I'm a
drawing
big fan.
all these comparisons.
Well,
so yes,
I'm a huge fan of the 1970s.
I love the miners here. You know, we've owned this gold. We buy every dip. I still, slow and steady. No one loves it because it doesn't move 22% in a day, and but it has been slow and steady. And I think still to this point, if you take a look on the long-term performance of gold, match it up against pretty much any asset class out there, including the markets, gold's an outperformer over a longer period of time.
Let's talk about a single stock that is moving the aforementioned 22% in a day. As a matter of fact, this is a stock that moved 30% today. That would be Affirm. Now, 30% move in a day is staggering. And if you think about it, you don't often see that. And this is not a small company. It's probably a market cap north of $12 billion or so dollars. So it's a big move. If you look at, though, in the context of where the stock was, again, in the fall of 2021, it looks like a small blip. But let's just talk about this for a second, because this, as you've mentioned a number of times, is a challenged business model. If it is in fact a business model, you can debate that.
Yeah. So
but why do things move like this?
Okay. Listen, it's short interest is big on this, not as big as Upstart, but call it 11, 12%, not huge, but certainly above average. We started talking about the stock when we started this podcast, and I called it short now, cover later, instead of buy now, pay later. And I do believe that it's an adverse credit selection type company, because why would people use a pay over 4 payments over a year, whatever it might be, when they could use a credit card and get points? It's a negative selection from the consumer. Give them credit for literally finding themselves in every single payment. Now they're going to Apple Pay, right, where they've aligned themselves in various places. However, what you don't want to see in this point in a cycle is a company growing their loan book like they have been. Yes, the Fed cutting is a positive for them from a funding cost perspective. They have yet, and I'll throw Upstart in this, yet to turn a profit in the company. They're saying that by this time next year they might turn a profit. Well, I'm a believer that consumer credit's going to get worse between now and then what's on their balance sheet and so forth will come back to bite them. Kudos for operating the way they have been. They still had a loss in the quarter. There's gains in sale. There's gains on sale on securitization stuff that goes on behind the scenes. But listen, it's stock's really done nothing. I think it's flat for the year. Not involved at the exact moment, although I probably will get back involved here on the short side here. So anyway, it's something to watch, but it has been a factor, I think, in the continuation of the credit cycle and the consumer's ability to tap other lines of credit, right, to prolong the cycle that's kind of out there. So something I'm watching.
Also this week, we had some interesting news out of the league where they play for pay. That would be the National Football League, Danny, which you handicap extraordinarily well. As a matter of fact, I believe it was 3 seasons ago where you had a heroic win-loss record.
Yeah.
Crazy.
Should have retired.
Should have stopped right there.
But I didn't ran both playoffs, both seasons. Last year did not lose a game in the playoffs.
Again,
there's
not.
I'm with it.
But that regular season that you had was historic.
Yep.
Something historic happened this week. The NFL approved private equity to sort of make a foray in with a maximum ownership, I believe, of 10%.
That's correct.
However, I think that's just sort of a placeholder for the inevitable moving from 10 to 20 to potentially entire owner. That's just my sense, given the magnitude and the valuation of some of these organizations, franchises. Thoughts on that?
Yeah, listen, there's people that hate Roger Goodell, and there's people that love Roger Goodell. The people that love Roger Goodell are the owners of these teams because they keep obviously going up in value. And there are a lot of private equity individuals
True.
which have taken stakes in some of these
Which
teams.
is different than
Correct. But they're not even letting – what's really weird about it is – not weird about it. I know why they're doing it. But private equity, to your point, historically doesn't invest in things where they can't own a majority position in. So you're right. It's a starter. It's good. It's a foothold. And not only that, they're allowing the same private equity companies to invest in multiple teams, by the way, except, Guy, Jim Chanos' Green Bay Packers.
Is that right?
Because
Well, they're
it's
publicly owned.
Well, exactly. So they're not allowing that to happen. So, but listen, it's just another point. And again, I go back to what is driving, what is fueling the value of these companies. And it's pretty simple to me, Guy. It's gambling and or television, which is directly related to gambling. So we'll see how this goes. But listen, great for the NFL to have another source of liquidity as we get ready for the season. But
well, let's talk about gambling for a second, because DraftKings, which, by the way, I've liked for a while, and I looked like a genius into the spring of this year, and it's looked really bad since, I want to say, the end of March. DraftKings has gone from basically $50 a share down to $34 a share. Not in a straight line, but pretty much. You've had some ups and downs along the way. Flutter is a name that you've liked.
FanDuel,
I still think there's something here in these gambling stocks. I mean, people want to cast aspersions, but the world is moving that way in a meaningful way.
DraftKings kind of fumbled a little bit. See how we did that on there.
Nicely done.
When they were going to put this fee in to their customers to offset these tax increases in various jurisdictions like Illinois. That was a big mistake to even announce. There's other ways to do that by offering less profitable or more profitable to the house parlays and those other ways to make money. FanDuel came out.
You
Flutter
could have hid those costs.
You could have hid those costs like everyone else does. Flutter comes out and makes a statement that we are not going to do that. What does FanDuel, what does DraftKings do? They undid what they were going to do. So a little bit of a misstep there. I do love DraftKings' acquisition of Jackpot, which is the lottery company. I think there are a lot of synergies there. So, Guy, to answer your question, there's still no Texas. There's still no California. So jurisdictions that could come online for these companies. And keep in mind one thing. The reason I like Flutter better, first of all, it's much cheaper than DraftKings on a multiple basis. It's like half on a multiple basis. It's bigger. Obviously, it's out there, but it's much more diversified internationally. And so, again, I like them all, but, I love Genius Sports, which is the data provider to these companies. And so, again, I think it's certainly a sector of growth here for the future. So,
by the time next week rolls around, the calendar will flip to September. The election is in November. I don't think, again, with a 16 VIX, we are pricing in the outcome of the election, regardless of where you sit, regardless of who you're voting for. It doesn't matter. I think things are only going to get more interesting along the way. Does the election play into any of this at all, or is it just sort of another presidential cycle that we'll get through without the market sort of giving a care one way or the other?
They'll care. I think the market will start caring kind of halfway through October, when this market's been about immediate gratification, what's right in front of them, no thought for the longer-term value of companies in general. So I think it will start to matter. And again, not to keep plugging it, but Vinny Porter and I dive deep on kind of what they're looking at, what we're looking at, kind of how to play that. But of course it's going to matter. And Guy, you know what people want? People want a split Congress, obviously, to happen under all circumstances, or at least not all three being the same, so that things can remain status quo. Because the one thing that Wall Street doesn't like, you and I both know, is uncertainty. And so if things become more uncertain, Guy, about all those outcomes, you're going to have a lot of volatility in the market.
Well, there's a lot of uncertainty surrounding this upcoming NFL season. Before we get into it, or before we turn it over to you, Vinny and Porter, are there any dark horse teams that you've done some initial work on, or do you want to wait until next week to share that with our audience?
I mean, I'll wait until next week, but I'll tell you right now that I'm already looking at the Thursday night game, the first one, Kansas City hosting Baltimore. I think Baltimore is the team you got to watch out for. They're not a surprise team. I think it'd be good, but I'm already giving out that take the 3 points. That I would take it right now before the season. You always short the Super Bowl winner. Mm-hmm. And by the way, I rode Kansas City all the way into to the bank
like a jockey,
right? When they were underdogs,
like
why
Flavian,
is Kansas City being underdog?
Flavian Pratt.
I think Houston Texans.
That's your sleeper team.
They're not even sleeper anymore. I just think that they're that. I think Stroud's the best.
A lot of Jet fans listening right now. High hopes on the back of a healthy Aaron Rodgers and a stout defense. Any thoughts there?
God bless Vinny and the Jets. God bless everybody who loves that team. I really hope Aaron Rodgers is healthy. That division is winnable for them for sure, right? So I think the Bills are on the down. So I love rooting for the Jets because it's that type of market. Got to be a bear.
When we come back, you're going to have that aforementioned conversation with Porter and Vinny, but I'll leave you with this note. the surprise player in the National Football League this year
Don't even say it, please.
will
don't.
play in New York,
Oh, no.
and his name is
You're out of your mind. Daniel Jones, you're out of your – okay.
Daniel
That will be
Jones.
the biggest surprise in sports history if that guy has a good season.
Stick around, folks. Danny talks to Porter and Vinny. See you in a bit.
Welcome back to On the Tape, another edition of What Are We Doing? There's been a ton going on. The last time you guys came on was on a Monday. It was a little bit over 5 weeks ago, which was followed by your debut, or our debut together, I should say, on Fast Money. And that was quite an episode, I must say. And Vinny, that's not a Jets hat, is it?
No, it's a Binghamton University hat.
Oh, Binghamton, bingo. Kind of similar
same
colors.
color. Same color.
Yeah,
yep.
because you reminded me when you were on, you said the Jets would make the playoffs. But anyway, guys, welcome back here. There's a lot going on. Let's get right to it. Let's start with the macro, and then I know people want to hear what you guys have been up to within the portfolio. Fresh off of Jackson Hole, a lot of stuff going on in Bank of Japan. A lot of the macro stuff is moving around. Give me your thoughts, Vinny. I'll start with you, just kind of on the macro market right now and how you guys are thinking about it.
Sure. I mean, I think there were two major events in August that are worth talking about. You mentioned both. Obviously, the Japanese yen carry trade, the let's call it 24-hour fiasco of markets running wild. And the biggest data point I took away from that was it took probably all of 6 hours for the BOJ to walk it back, or at least talk it back from jawbone it from a narrative perspective, which showed to me that our thought process that central banks are going to be extremely proactive to suppress and reduce volatility whenever volatility pops its head up. They did not allow this to fester, not one iota. And within a day or two, everything came back. To me, that tells me that the Fed and global central banks are being very proactive. The second part, which was Jackson Hole, and given what I just said about the Japanese yen carry trade, I shouldn't be surprised, but I was a little bit, how convicted Powell was to a cutting rate cycle. Like I thought when walking in, he would kind of do that classic 52-48, right? Which is, yeah, we're going to start easing, but guys, look at the markets, look how tight it is. It's going to be really slow. And he did say that, but I mean, when you hear statements of, we will do everything we can to support a strong labor market, we do not seek or welcome a further cooling in labor markets. Those are kind of like European style when what's his name, Mario Draghi did, or whatever it takes. And it doesn't really feel, I mean, look, the world is slowing, nominal GDP is slowing, but it doesn't feel horrible out there. So I was a little surprised how convicted he was. And those were the two things that really set the tone for the next few months, at least when it comes to the Fed, is that we're now in an easing cycle. And the question is degree.
Well, let me say this, Porter, before you go here. Let's be clear. They coordinated Ueda speaking in front of Parliament on August 23rd. They announced that after. Powell was already obviously always going to speak on the 23rd. And the amazing thing to me is, and this is a statement of the obvious, at least to the three of us, is the stock market. We used to call it Bernanke's precious, was the market would indicate and drive policy. And the market, I'm not saying in this case drove policy, but it drove people to lose their minds for a 75 bip rate cut, right? Because what the Bank of Japan, God forbid, raised rates from a range of 0 to 0.10 to 0.25%. I mean, so we're really, and I think it's more indicative of what we've been addicted to since the financial crisis, right? Which is liquidity. And God forbid any liquidity comes out of any of the asset bubbles, including the stock market. So, it's amazing to me, not how thin-skinned, but how impatient these regulators are, and they just, bow to the populace out there. But Porter, with that kind of as a intermezzo there, give me your thoughts here on the macro. Maybe shed some light on Vinny's comments.
All right. Well, it's fun to be back, Danny. And, I think when we were on CNBC, we were messing around and had this thing called Make Volatility Great Again.
Yeah, you
And
did.
part of it was Trump. And at the time he was leading in the polls by quite a bit. And he's tried to hurt himself, and he's done successfully hurt himself. And race is pretty close now. But, you have, sort of call it August, September, October, which is, you knew we were going to be messy going into the election. Um, and then I think that the dollar's gotten demolished over the last 3 weeks, and vol's picked up, and I think that's one of the themes here is that, and we obviously just saw Nvidia print earnings here, and they were fine, but whatever. And Vin touched on it. It's the start of whether I believe it's correct or not, which I don't. But we're at the verge of a cutting cycle here. I think you're going to see a lot of rotation in the market, and probably out of tech, which historically has not done well in the first parts of a cutting cycle. And so, and you've seen these defensive names, and we were looking up this Colgate Palmolive today. Stock's absolutely ripped, and God bless it, but our Philip Morris is also ripped. That's sort of a defensive name, steady cash flows and such. So we got a little bit lucky with that. Gold's done well. So
Let's go back to some, Porter, which you and I have talked about. I want to stay with the macro here for a second.
Mhm.
And that is that I just saw, I don't know, it was the Congressional Budget Office or it might have been Penn, came out with a study on both policies. And we know that politicians speak to just to get elected, and a lot of the stuff has to pass through Congress and a lot of the stuff won't. But the bottom line is that deficit's going higher no matter what party wins. You can't escape that, which is why I keep saying people making a trade on the election based on either the extension of tax cuts or further tax cuts is just not realistic. And this is only going to get worse and worse as we get closer. So you talk about the weak dollar, you're talking about gold. It all points to really one thing for me, which is the deficit is starting to matter here. And so I know you both have thoughts on that. But Porter, give me your thoughts on that. And I want to hear Vinny's thoughts just in general on, we have a lot of people, a lot of professional investors out there who say, don't worry about the deficit, don't worry about the debt, you shouldn't care. I care.
Okay, so let's play it forward. We're adding, I think it's $1 trillion every
100
a little bit
days.
less than a quarter, right? So if you roll forward to 2028 elections, I know it's a long time away, you're staring down the barrel of $50 trillion in debt, right? And so the numbers just don't go down. And so that's what I keep looking at. And you know, we're going to be in this game where how Yellen was playing the issuing more bills than coupon to try to bring down rates. And listen, she did a very good job. She brought rates down 100 basis points in the 10-year over the last 4 months. You might call it cynical, whatever. It's an
That's a
existential
Band-Aid
threat.
though, but that's a Band-Aid on a huge wound. This doesn't really do anything, but I hear
It
you.
does. I mean, like that they have. This is the lifeblood of the economy. They have to issue this debt, and they got 100 basis points off. It's a big deal.
So, Vinny, the whole idea that fiscal stimulus had been such a huge part of kind of the money in the system, this is part of it also, right? You're not going to get really any of that. You're not going to be able to pass anything that resembles that will inflate this deficit. So, give me your thoughts on this, and then I want to go into how you guys, obviously long gold like me, are playing this.
I wanted to channel my inner guy Adami, but I need to use your voice.
All right,
But unfortunately, I don't have the information to know who sang this song.
all right.
So for whatever reason, when Porter was speaking, and as you know, pop culture flies in our head. It's like kind of like Mike TV from Charlie and the Chocolate
You're not going
Factory.
to do some Diana Ross on me, are you? Or
Okay,
no?
close. It's an R&B. It's an R&B song, and it was like we're in this
Is
mess
love
together.
together.
So instead of love, it's mess, right? This is a freaking mess.
Yeah.
And whichever way I look at it, the deficit is going up, and no one's really that is not a talking point for any of the parties. So when I think about that, I come back to someone else you guys had on the podcast, Luke Roman, and the only outlet is the dollar and debasement. That's it. It's the and there'll be fits and starts where we'll be proven wrong for a day or a week or a month, but at the end of the day, that's what needs to happen. So the logical conclusion for us, and it's our largest position in the portfolio, is gold and a little bit of silver as well. And as much as it scares me from time to time, because it has worked and it has worked well, and sometimes it gets into overbought conditions, uh, I just don't see how this doesn't continue to rally over the next year, 2 years, 3 years, because policy is suggesting that you should be holding on to stable, tangible currencies. and gold is the most historic.
Yeah, we've seen
I
a lot
I
more
prefer the
volatility. Sorry, we've seen a lot more volatility in crypto than you have in gold in terms of the swings certainly lower. And with gold, I think every dip, I think the three of us agree, is a buying opportunity. Let me just plug Luke Groman is coming on in 2 weeks. So it'd be great to get his thoughts. We get you guys, we get Luke, we only get the best. So Porter, sorry, go ahead, bud.
No, I preferred the Diana Ross reference, which we were using to a different stock earlier, but the upside down.
Oh, you
Wow,
time.
look at us with the RMB. It's
I
People don't
know.
understand they're out there on the trading desk. No matter something would happen, it would trigger a song. And at the end of every year, I think I've talked about this. We had a holiday party. We took out all our brokers and everybody, and then we gave out CDs, which actually was still a thing. We actually made CDs, and we had anywhere between 15 and 20 songs, and they all represented. And Vinny's going to go find one. They all represented something that happened. Like what was the one where why is it in the portfolio? Was it the Wham song? What was the Wham song, Vinny? That why are we
You
still
want the
in?
list? You want
Yeah, I
the
want
list?
the list. Yeah, give me the list. What year is that?
Don't know. It doesn't say the year.
All right, give it to me.
I apologize. The Beatles, Let It Be for level 3.
Level 3. That so people I wouldn't give Porter the real price of something when he came to the
We
office.
might go overboard with this. I apologize in advance, but this is kind of fun. You could cut it out. That's fine. Danny's favorite, Porter, Crosby, Stills, and Nash.
Yeah.
When you see the Southern Cross for the first
Southern
time.
Cross. Yeah.
Golden Cross, yeah.
Golden
Counting
Cross.
Crows,
50 pitches,
Counting
200.
Crows, Omaha.
That was Nelnet. That was for Nelnet, it being headquartered in Nebraska.
Omaha,
So we
yeah.
own that stock. Yeah, keep going. This is really good.
Big Daddy Kane, Warm It Up Kane. That's a Queens.
Yeah, that's
reference
you.
to
Yeah.
Queens.
Yeah.
We've talked about this before in prior podcasts. Take the long way home. Take the 4 train home.
Can't afford to take an Uber or a taxi. You're on the subway. Take the 4 train home. Yep.
Wrath of Khan.
Wrath of Khan. By the way,
Oh
we didn't
my
get to talk
God.
about this. We didn't have to talk. Let's close the loop on that one. So we've been involved years ago in a company named Cons, which CONN. And the reason the reference of the Wrath of Khan that Vinny had on there, because when it would obviously go up when we were short it, we would play that scene from Star Trek in the morning. The Wrath, when he said Khan. Anyway, long story short, it basically failed because what they were doing was they were basically just giving out loans so that consumers could buy their products, otherwise wouldn't be able to afford them. And we knew at some point it would catch up with them. Well, it finally caught up with them. And I'm going to hand it off to Porter to give the irony of what just happened. So we're no longer short Con. I don't think you were either. I kind of had forgotten about it. But it was acquired not too long ago by a company. It actually set in motion the potential, what the debacle that's certainly going on at a certain company that's a brokerage firm which is associated with it, that actually was the final nail in the coffin potentially for exposing everything was happening at the firm. So it's really amazing how you forget about these companies, they're cockroaches, they stay alive, and then they come out and show their face in some other way. So let's talk about B. Riley, which you guys have been on the podcast before, talked about this name, not recently, but you've talked about it. I know you've been involved in it, not as outspoken as some other kind of short sellers that are out there. But talk us through what has happened to this thing. Symbol is RILY here, and why it's so important that people do the work and dig deeper into these Qs and Ks and whatnot to really understand what they own.
By the way, back to the connection between Con, which the ticker is now Con Q, obviously. The stock went from 4 to 80 from the 2010 to roughly where we shorted it. And we had brokers, friends of ours, because we bought so many Con 40 puts. They made us. I have a Mets jersey that says Con 40 puts. Vinny has one too, and Danny's got a Braves one.
Mine's the Braves jersey, and you guys have Mets jerseys. But yes.
Anyway, stock got crushed. We made a killing, and years later, Riley's in financing the business and financing their inventories, and they financed a sale to FRG, which is a sub of Riley. It's so confusing. But anyway, Concept ends up going bankrupt. Finally, the final nail in the coffin was the bankruptcy when Riley de facto owned it. So, which we were short Riley. But it just it was funny that it kind of came full circle.
And I'll tell you this, and I want to go into this because it's important. So people vilify short sellers, and let me just explain something here. So if you were a B. Riley client, you were being sold, correct me if I'm wrong, these trust preferreds over the last couple years potentially to finance basically some of the balance sheet of Riley, whether it was going to a various investment, whatever it might have been. Wouldn't it be great?
5%, by the way. That was they were selling them. You were getting 5% coupon.
Right, 5% coupon. Wouldn't it be great to know as a client of B. Riley why you're being sold this, what it is, and what it really is financing? And the point is that if we can help people, you don't have to be short the stock, you don't have to be long the stock, but take the information and apply it. If you were a client, there's not. I know this thing's still going to play out over time. I'm not going to try to predict what happened, but Vinny, you see this stuff on the long side where people get credit for finding a catalyst, which I know you've done in the past. We'll talk about that, and being a quote activist, and that's really the Elliots of the world and so forth that go in there do it. But the long see an opportunity where there's inefficiencies in a company where they can make a difference, and they take a stake and they try to invoke change. On the short seller side, it's if the regulators aren't going to do their job and people aren't going to pay attention, right? Somebody out there needs to be a voice. But it is amazing to me how short sellers get vilified. And listen, there's some bad short sellers out there who do pump and dump on an opposite way. There's also some bad activists out there who pump and dump the opposite way. So, Vinny, give me your thoughts on that, because I think this is still a crucial tool in the marketplace as far as price discovery and just discovery in general.
Well, first off, I mean, you stepped on, it's a sad but permanent contradiction, right? Whereas you're going to be excommunicated if you're a short seller of any kind, despite the fact of how poorly run or fraudulent a company is, versus on the long side, forget about if you're an activist. If you're pumping and dumping long stocks, it seems to be hunky-dory and good. Speaking to most of the people or a lot of the people who are activist short sellers, right? And we're close to a lot of them. I could tell you they get personal praise and reward to themselves when they expose a fraud. And they feel this, and yet it is extremely difficult for them to go through it, because my word, the whole world goes after them. But if and when they win, many times they lose, they feel so good that they put a crook behind bars, or they made a CEO and chairman who were robbing shareholders or employees lose their money. I don't know. Maybe it's us bears. I just think there's something really, altruistic about it.
But one of the biggest problems with it these days is that the algos have picked this up, and a lot of there's so many algos that directly target companies with short interests are super high. So it's crushed the short seller, right? They can't do what they used to do because the game is so hard. I mean, look at Codes is out there publicly saying, B. Riley will be my last short sell ever. I don't believe him, but he's like, it's just so hard to do. Like he can't do anymore.
Listen, if you're a company and you're being attacked by short sellers and they don't have a case or whatever, the argument should be come out and present your case and shoot them down. And sometimes that happens, sometimes it doesn't. But when you get a run in your stock, because Porter, your point about heavy short interest, these companies are crazy not to issue stock at those levels to take advantage of a squeeze. And I'll say this, I don't have the exact stats in front of me, but I've said this on the show before. The companies with the highest short interest over a long period of time are the worst performing stocks, generally speaking. It takes a lot to undo a stock that has 50% short interest because there's a reason that it got there. And I'm not talking about a technical reason because it has debt outstanding and converts or hedging. I'm talking about the absolute of the float itself. And so just something that people should watch. And again, helping people that are thinking about working at a particular company, changing their careers to a particular company. It's just good to know kind of what's out there. And I want to go back to one thing which we didn't talk about, and we mentioned this upcoming election and whatever happens to the deficit and debt. How are you guys thinking about playing the election right now? And then we're going to get into your portfolio per se, which may or may not be impacted by it, but just in general, your thoughts of how you play from here.
Well, the only thing I can say for myself, I can't wait for us to be over. I don't particularly care who wins. We have two Trump stocks in the portfolio. One is Geo, although it's been in there way before the election.
Private prison, correct?
And we do have a bit of the Fannie Mae preferreds, which we
Vinny mentioned on Fast Money, so that's out there. We know that. Yep.
So So from that perspective, we've kind of gone through it many times. I don't know that our portfolio cares either way of which one wins. So that's kind of how we're playing it. It's too close to call. Too many games to play in between, and so we're just not going to.
So you're not making bets based upon the outcome. And I think we'd all agree, and Vinny, I want to get your thoughts, that kind of a split Congress is what everybody kind of wants here, I think, so that, from a change perspective, I think status quo right now is what investors always want. They don't want, they want things that are consistent. But Vinny, give me your
But this
your
is
thoughts.
also like, I've said this many times, as an investor, I don't think it really hurts you if you have political views, because you have such biases in the market. Like what we're trying to do is, as we get older, strip all our biases away, look at it objectively, and all that kind of stuff.
Porter, to be fair, we do have, you guys have, and I have a stock called Tesla that is going to be a huge it is the election stock to me, because Musk wants to protect himself with a Trump administration. And if he doesn't, what he's done now is moving to one side. So I do think that name is one of them.
Well, Tesla has become more and more, it's always been a political animal, because he has been a political animal, and a really good one, in terms of gathering whatever he needs to do to gain the subsidies to increase the value of his empire. But he's made a choice, a very definitive choice this time, and that he's choosing one side versus the other. So in a Harris administration, we'll see. He always seems to be the roadrunner and get away with things, but it might be a little bit more squirrely if the other side wins.
I have to say, it's not a great strategy for him to be so political. Like, there's not many other people that are that political that are selling a massive consumer product. You're cutting off half your audience.
Well, he doesn't care about his earnings. He doesn't care about his revenue. He cares about his personal protection. And I think the amount of agencies that have been after him he feels like that will go away. And then the other stuff will just fall into place, and people will still believe this autonomous crap and all that other stuff. I believe it's just a short-term fix, Porter, to your point. And the fact of it is that he jumped on the train thinking he's on the right train, and we'll see what happens. But
he is a completely protected person. There's no doubt about it. Yes. Right? He has NSA clearance. He has everything. Like, the SpaceX is fixing the space station incident and all this sort of stuff. And so, I don't know.
But in terms of the election, Danny, quickly, I don't care really who wins or loses. I mean, I do, but it doesn't really impact what we're trying to do here. But at the end of the day, I don't think we have definitive views who's going to win. I feel it's like a 50-50 coin flip. And as a result, I really shouldn't have a significant amount of capital going one way or another. Aside from, I would say, small position in the Fannie Preferreds, most of our positions that are politically oriented have some fundamental aspect to it, above and beyond just the election. Yes, they will benefit or go down as a result of the election, but they're not there because of the election.
Well, we had, so having traded financial services, which I think is the industry most impacted, the sector most impacted, the banks are, right, which I'm going to talk about. I know you really haven't been involved to them. And then you have things like the CFPB, the Consumer Financial Protection Bureau, which is out there guarding against these payday lenders from charging credit card companies from charging high fees. So yes, there are other ways to play it when you get into our sector, but you guys aren't even really involved right now within the banks, I don't believe. So what are your thoughts here on kind
of? I wouldn't say we're not involved. We're involved in a very idiosyncratic manner, right? But we are not taking a thematic directional bet on the banks. You brought up the reason why. If you believe that the election right now is a 50-50 bet, yet the outcome of the election is quite binary to the success or lack of success to a certain industry like the banking industry, the last thing you want to do is make a major bet one way or another before a very binary outcome of which you have really no definitive opinion. So as a result, we have shied away from the group as a whole. We were actually, at the end of July, we were short the KRE, not because we had a definitive view on the banking system. It was just because it was trading like 20 or 30% above the 50-day moving average after that massive sector reversal. And then we quickly covered it slowly after the Japan vol crush, and then after the Powell super pivot. So, but right now we have really no involvement in the banks as a general overall bias theme.
They're really trading like utility stocks. I've been saying that now for 2 years, and some of these they pay dividends. There's buybacks. well capitalized. There's not a ton of risk. They're playing off of the flows of the IPO and M&A that's been going on. And again, to touch on one area, and then we'll move it outside of the banking area, is private credit. And I talked to you guys before we obviously came on air here, just about kind of the fallen angels and what we're seeing within high yield. And private credit is really taking they're not taking the $2 billion deals, the $1 billion deals are taking the 25, 50, $75 million deals and allowing funding to occur. And it's really, I think, is extending the cycle, I think, that we've all kind of seen. But the banks aren't doing that as much as they used to, obviously, but that's good for them because when the credit does turn, it potentially won't be as bad. But give me your quick thoughts on private credit. I know we've talked about it before. I don't want to spend a lot of time on it.
On the private credit, listen, the big private credit players are so big, they, if you put it into perspective, Ares and, Apollo, they're as big as top 10 bank in the country each. And so in terms of their impact on the private credit markets. And so, listen, I think that they've taken a lot of share from the banks and they will continue to take a lot of share from the banks. And so, I don't know how that plays in the economy, but I just think that there's more, liquidity being thrown at this economy than people think, and that's one of the reasons it keeps me not bearish, right? And whether it's Powell, whether it's private credit, whether it's Yellen, there's just a lot of liquidity being thrown around here, and when the liquidity dries up, you're going to see us get a lot more bearish, and you just haven't seen that yet, and so. For now, markets basically at an all-time high. Yes, Nvidia is off a little bit today, but I just think that status quo for now.
I will say this, Danny, just quickly, if we're in a recession, this is a pretty odd one, right? Markets are what? 1 to 2% away from its all-time high. Credit spreads, as much as we talked about it, are tight. Securitization markets are wide open. This is sort of like the vibe recession where it's slightly off and people are going a little nuts. You remember, and I'm not even talking GFC right now, right? Just in typical recessions, what we see and our neck of the woods, the securitization markets are frozen. No one can access credit from a wholesale funded perspective. And the exact opposite is happening right now. If you want to securitize consumer loans of any kind, you could get it done quite easily. Spreads are pretty tight. Markets are fairly open. So maybe I don't yearn for the days of the old recessions, but I look for the characteristics of the old recessions to get really nervous. And so far, I don't see them.
All right, let's get into some single names you guys have been involved with. You've been public about some of them, obviously. One name in particular, to go back to Washington for a second, and why you have to pay attention to these agencies, is Glass House. You guys have been long this name. It's a cannabis name. And what the DEA just did after a long period of time of sitting on this thing was decided to have a hearing on December 2nd, which is obviously a month after the election, to gather more comments on what they're going to do. And they're probably waiting to see the results of the election because they don't want to do something and then have it undone potentially if the Republicans were to win, if that were to be the case. But you could still potentially, after the hearing, you could get a rescheduling occur from 1 to 3 prior to the turnover in the administration, if that's indeed what we have. So they kind of obviously pulled the rug out a little bit, and you guys have not been involved in cannabis as long as I have, but that's a customary thing in this sector. It continues to be. So thoughts on the Glass House, which had a great quarter in the midst of all of this, and then let's get into some other names.
So, when you underwrite a position, you hopefully you underwrite it so the government can't pull the rug out from underneath you. And so we underwrote this position that it wouldn't get rescheduled. All right. And, can we make money without a rescheduling process? And I actually think the prospects for Glass House are even better now than they were last week, 2 weeks ago, whatever. And one of the reasons is they're pivoting slightly to, part of their growth has been in obviously cannabis and these opening the glass houses, but it's now going to be towards hemp, and hemp is going to be selling at an ASP, a price that's much, much higher than where they're currently selling California cannabis. And so I think it's going to be a huge boon to them. And, in the meantime, while their competitors are being hampered by slightly lower prices in California and delay on rescheduling, Glasshouse is just going to cash flow and keep getting better. So the differential between Glasshouse and the rest of the cannabis is just increasing right now. And so the stock obviously dropped from call it $9.50 to $8 on this news. We obviously added a fair bit here. So
I know we spoke highly of uranium on CNBC the last time we were on, and probably the last time we did this. And I've come to an epiphany, Danny, that I found the sell in May and go away, right? It really doesn't exist anymore, particularly when it comes to the Mag 7 or the Fabulous 15 or whatever you want to call it. But it does exist in commodities and energy. Like the commodities and energy market by May 15th just sells and leaves the building until September. And uranium is no different. Unlike a lot of the other commodity sectors, the news flow in the uranium sector has been extremely positive. In fact, last few days ago, the largest supplier of uranium in the world, Kazatomprom, substantially reduced their production estimates for 2024, 25, and 26. We got a one-day pop, and the stocks have come back down. So we've been slowly building our positions over the course of the summer. We come to learn that summer, nothing really happens in the uranium market, so there's no real rush. But we've been slowly building, and every time it goes down a little bit more, we buy a little bit more. So we've accumulated a bigger position over the last 3 months.
So one of the stocks we talked about or I pitched on CNBC was Pure Cycle Technologies, tickers PCT. And it took a little bit of a life of its own after I pitched it because the short interest is so high. It's called 30-40% of float is short. And so, this company they've just never been closer to producing, at full capacity or at scale. And it's my belief that, over the next few weeks that they talked about this in the call, over the next few weeks, they're going to make an announcement about their production schedules. And if they do, I think that, and it's successful, I think you could see a stock which it's substantially re-rated from here up to 20 to 40% higher potentially. And so, that's one of the things. It's sort of a not a flyer, but it's a higher risk reward stock that we have in our portfolio. Obviously, we have a mix of high risk, lower risk stocks, and that's in our high risk bucket of stocks. But
so we were on CNBC. Vinny talked uranium. You talked about PCT. Vinny talked about Fannie Preferreds. You talked about Tesla. I talked about a stock that we have been involved in with you, Genius Sports, GNI, and the reason that nothing fundamental, although they did have a great quarter and guidance was good and all that, was a technical reason. And I think it's important for people to understand from an opportunity set. They had a private equity owner for years that finally sold out of the stock, and they did it in a very bad way. The Apex sold it in a very choppy way, all kind of below $6, and it took 9 months to basically get it done. But when the final print came out and Goldman Sachs did the deal at 5.25, that was what Porter and I used to joke about, clean up on aisle 9. If you have a fundamental belief in a story that's been held back on a technical aspect like this, that is your signal to really use a poker reference, go all in on something. And so you see these opportunities pop up. And Vin, you talked about AerCap last year when GE sold their position. Again, these are secondary sales. No one's raising primary capital. There's no dilution. It's a change of hands, of which AerCap, I believe, bought stock as well. So for people out there, when companies issue primary stock and or there's insider selling, that is a secondary transaction, that's one thing. When there's a technical cleanup of someone that sold a stock for reasons that have nothing to do with fundamentals, that is your signal to kind of buy. So Vinny, sorry, I didn't want to steal any thunder there, but I did want to wrap up that it's important. Bottom up is everything, but it's amazing when the technicals come into play on names that are out there.
Well, particularly in a name that you like, right, Danny? I mean, like exactly. You said with the fundamentals, we were following, like you've been following Genius for a while now. We've been following AerCap for a decade and change. I mean, I'm on record as saying I think he's the top 4 best CEOs that no one has ever heard of, in Gus Kelly. And so they acquired this aircraft from GE for at a discount to NAV, at a discount to book value. And then they take a bunch of the planes and then sell it above book value. So when GE was ready to sell, and it was a large sale, and I think it came in 2 or 3 pieces, AirCap participated in it, I think, to the tune. My numbers are going to be off, but a tune of like 15 to 20% of what was sold, AirCap was repurchasing. You don't get things that are that easy that often in life, but like when everything lines up like that with the person you love, with the fundamentals that are great and all that, you just have to jump at it, and we did. And I'm with you.
It was a triple whammy too, Vin, because they bought the planes from GE at a discount, sold the planes at a premium, then bought their own stock back at a discount when GE was selling. It was like a triple whammy, the whole thing.
Talk about accretion, and the beauty of AirCap right now is that the market's figuring it out. I mean, the stock, I can't say the stock is trading near book value, which has always been its ceiling. I actually think it should trade at 1.5 to 2 times book. Whether that'll happen, who the hell knows? I wouldn't underwrite to that because it never really has happened, but it should. But we're very comfortable still owning the stock because he's just a rock star. He's great.
This is one of the things where it's a perfect example of where active investing still has a role, where you can take advantage of passive investing and flows where no one's really paying attention to and get a block. Not that we're buying blocks per se, but if you understand how the system really works and it's supposed to work, therein lies the opportunity for these things. So I think it's great to point out. And I don't think there's enough eyeballs anymore, which is actually great for funds like you and people like us that like to do bottom-up work. So give me your guys' thoughts on energy here. We'll hit a few more names and then we'll get out of here. But I know energy is a big area you guys continue to focus on.
Well, I mean, one of the things that's happened is that, obviously the dollar's been very weak, which is, historically been good for stuff like gold and oil and stuff like that. So, I actually incrementally, we've been adding to some oil names here. Petrobras is a stock that we've owned for a long time. We've been just collecting dividends on it. And so, it's a stock I like a lot. And, the coal names have been weak. A lot of fears about, especially the met coal names have been weak. And so we're starting to do more work around that, starting to do more work around BTU.
Is that because nat gas has come in so much that the coal names are weak by?
Yeah, that and combined with China has been an eyesore from an economic activity perspective, which impacts so many different commodities. I mean, if you talk about the one data point that impacts commodities more than anything else is incremental growth in China. And as a result of it, because it's been poorer than expectations, almost every single commodity has been south.
Iron ore, everything's been very weak.
The whole push and pull, geopolitics and tensions in the Middle East versus China, where oil's been kind of range bound between 72 to kind of 82, wherever it's been. So that's really been a tug of war. But I know you guys use it as an input, but a lot of the balance sheets and stuff you guys are looking at, companies that you're long, could survive on, I mean, you don't want to see it go there necessarily, but $50 oil or $55 oil, but it does get to a point where you really have to start to care on, on both directions for sure.
And you bring up a great point, Danny. The real story to me over the next 3 to 6 months, yes, we have the election, yes, we have a bunch of other stuff, is are we entering a recession or not? And it's the analysis that we're trying to spend the most time on, because I was looking at work that was put out by our good buddy Shrub. He writes a daily or weekly periodical. And, the running joke for us bears is that, and I hear it from a lot of people, is that when the Fed is going to cut rates, when they actually start cutting rates, that's when the market goes down. And it's a little bit more nuanced than that. What it really means is if the Fed is cutting rates because we're entering into a recession, every time they cut and we enter a recession, the markets are down. But every time they cut and we don't go into a recession, the markets go up. So we're trying to spend a lot of time to see whether this is live or Memorex. And that really will dictate whether energy, which has underperformed, which once again is not in anybody's radar or institutional portfolios, of whether it's really going to outperform over the next 6 to 9 months. If we do not go into a recession, these things will be massive outperformers. If we do, there's another leg down before you really have to start buying them again.
The other thing that, as value guys, and we do a lot of screening, try to look at what's cheap. And from that, hey, what looks cheap to, hey, where can we get a catalyst to inflect the thing to look super cheap, and people end up buying the name. And one of the names, and Vin talked about whether it's a recession or not. One of the things that we think about is that what's going on in China, right? And China's been very weak, and everyone's very worried about it. But look at some of these stocks, like JD.com announced the other day a $5 billion share repurchase. These things are swimming in cash. And Walmart sold, I think they had a 9% stake, sold it. They took down a huge slug of that Walmart block, and then kept buying after that. And so, if China doesn't slide into this recession that everyone's talking about, some of these names could be very, very cheap. And we keep refreshing the names, keep looking at them. Hey, maybe it's interesting. And so that's one of the names that we've been looking at recently. So
yeah, I think to Vinny, your point, GDP contraction as the definition of a recession of 2 quarters of negative GDP, whatever. We've had a rolling recession in various sectors that have been occurring over the since COVID. And so being able to recognize that, take advantage of some of these things, like you mentioned before, or we've talked about before, building products in certain areas, which getting hammered. And some of the retailers,
autos. I mean, CarMax sales, they're getting killed.
Before we got on the screen, we were looking at Builders First Source. It's kind of like a value, institutional value investors' darling, well-run, margin expansion and the like. However, what's interesting is in 2022, and they haven't done any acquisitions lately, nothing of materiality. In 2022, their revenues were $22.7 billion. In 2024, their revenues are projected to be $16.8 billion. When I look at that and say, well, housing has been in kind of a recession. Now, you wouldn't notice it based upon the home builder stocks, but just looking at the revenue streams of one of the largest suppliers of lumber and other products to the housing market, that's a big drop in revenues. So the interesting part is, can it get worse? Yeah. But if these interest rate cuts stick, perhaps housing will inflect positively. We'll see. And these are the questions we're asking ourselves and thinking about names to put in the portfolio.
There are, I always joke, I'm like, a Fed cut won't do anything for it. There are certain sectors, obviously, that are directly impacted by the Fed cutting rates. And home builder and construction is certainly one of them that certainly gets the benefit. Now, some of these stocks, to your point, may be already anticipating that. It's potentially built in, obviously, to that. Obviously, the market's pricing in Fed cuts. But again, that's what makes a market here. So,
I mean, guys, Danny, one interesting point about that is that, everyone's talking about Fed cuts and stuff like that. Inflation's still 2.9%, right? And their targets too, remember? And we're talking about Fed cuts. We've got a weak dollar because of that. And, oil sort of kind of ticks back up again. And so, one of the things that I think about and, is that does inflation reaccelerate from here, right? And that potentially puts a damper on things. I mean, the Fed's going to cut because they have they're got an election to win, and they got, other stuff going on. So,
Powell already said that. He said at Jackson Hole, he's watching employment first and inflation second. And as inflation keeps trending, he'll take the risk that he'll just start cutting at 25 just to get ahead of potentially if the economy really is slowing, the labor market is getting worse. Then he can feel like at least he saves face. But again, it's more symbolic in nature right now. But I'm with you, and I don't think 25 bips is going to exacerbate inflation. It may loosen credit conditions or keep loosening to a point where it becomes self-fulfilling. He may have to do something hawkish cut. Will be probably the talk by the time we get to September, and we'll see. But
and Danny, the amazing thing is that I just finished this book by Andy Shales about the Great Society, and it talks about the Johnson and Nixon administrations. It feels very similar to what happened in post Nixon, post 71, going off the gold standard, and Arthur Burns, and it has all the makings of this stuff, right? A lot of spending on social programs and war and all that kind of stuff. It just feels similar to me.
Danny, I doubt Porter can pull this off, right? But me and you should probably go out and channel our inner Tony Manero, buy a white 3-piece suit and a black shirt, and relive the Saturday Night Fever soundtrack because, and if anyone who hasn't watched it, it's a great movie and it's a really good indicator of what was going on with inflation at the time because
Well,
there were a lot of
it's a tribute to Guy Adami. I mean, that's his era. He's
Yes.
the best movies, the best music, the best everything. So with that,
Fantastic.
guys, we're going to have you obviously, back on here probably around the Fed. My guess will be around that time period. So Ken, thank you enough for coming on again. Have a great end of the summer, great Labor Day. And I'm sure we'll be talking a lot, but we'll have you guys back on here in a few weeks for sure.
All right.
Awesome.
Have a great one.
Thank you.
Thanks, guys.